Markets Now is brought to you by the 5-year anniversary of Brevant Seeds. Here's to 5 years of not just winning, but collecting one game-changing W after another. See all of our wins at brevant.com/wins.
Welcome to Markets Now. I'm Michelle Rook with Mike Zuzolo of Global Commodity Analytics. Well, a mostly higher day in grain and livestock futures, except for nearby live cattle futures. Mike, I want to start off talking about the grains. We did see a little higher prices there. It looked like we were led by wheat. Was that short covering? Were we putting in a little risk premium? Or was that the lower dollar?
Yeah, I think it was the reversal, not technical reversal, but the sentiment reversal in the dollar. We had macro data that came out kind of out of nowhere, and it makes sense because of the shutdown and some of the negative forces in this market, like consumer sentiment. But the producer price index was above the trade estimates, Michelle, and I think that kind of generated a little bit of a second guessing by the bears in the grains, especially with that dollar falling lower. I would also add the idea that, why we talk about wheat so much is because wheat and crude oil are the two canaries for oversupply in 2026. I mean, Department of Energy has 2026 WTI forecasted at like 51 and a quarter. We're still, $6-7 away from that as an average price. And so we need to get wheat and crude oil to start moving higher, not dragging the rest of the market lower. But that weaker dollar did seem to do that as we got to the mid-session today. So I think we've got the wheat market starting to be positioned a little bit better, depending on what happens with Russia and Ukraine. That's the other shoe that probably could drop here. If that, peace plan potentially falls apart, would that create a quite a significant amount of short covering in the crude oil? I think so. And then that would maybe bring back the idea we've got winter weather for the U.S. winter wheat belt. Crop conditions good to excellent they're up 3% versus last year, but very poor and poor actually up 5% versus last year as well. And so I think we could have a situation develop if those outside markets would allow it, that we could put a little more weather premium in this market.
Mike, some of the pressure that we've seen in corn and wheat futures the last week or so has been some of that liquidation, that farmer selling again ahead of first notice day. Just about everybody has to be out of those contracts by Wednesday. So is that when we start to see this market rebound a little, or does it not matter this week because it's a holiday week?
I think it matters because of that spread and because we need to see DEES 25 migrate up to March 26, not see March 26 fall, because that corn market really hasn't done what it needs to do fundamentally. And again, I put that at the feet of the wheat. If we do continue to go and slide lower, Michelle, I would bet it's because the dollar's being bought again, crude oil's weakened, and the wheat falls back into that macro mindset.
So the corn market right now, we've been trying to absorb the large crop because we have such good demand. Are we doing that? Are we going to be able to get out of this trading range that we've been in at some point because that demand has been so good?
Yes, I think we can. We need the wheat because the wheat's back almost a feed grain at about $1 a bushel premium to the corn. I've noticed that the DEES March spread has widened to about 16 cents, I think it was, on Tuesday's close. And that's going into, as you say, first notice day on Friday. That would suggest we've had some farmers selling. And so I think we could have, after the DEES goes off the board, a big move in terms of potential move going back up another 20-25 cents. That seems to be, given the world supplies, Michelle, where I think we should be. I think we should be at 475, 480, whether it's March or May futures, you pick. But with stocks still tight in the world, and the tightest since 2012, 2013, we are really kind of razor thin. And if Argentina didn't plant that 1.5 million hectares of corn, that means something.
Let's talk a little bit about soybeans, because it felt like we went down, tested the bottom end of the trading range, and we've kind of held there. So we need fresh news, China or otherwise, to move us back up to the top end of our trading range.
Yes, and I would not want to take out what last Friday's low of around 11.13 in January. Now that the November is off the board, this is a market that is in dire need, in my opinion, of feeding the bull, because we're running 7 straight weeks higher at this point with the gap to the downside. And so I think the beans are back in a position where it'd be great to get some new Chinese demand news, especially the last week of November, and being short that 6 million metric tons. But I think it's probably going to more or less be up to the wheat and the corn to help support this soybean complex. Otherwise, we may see a more significant pullback, especially if that South American weather turns into a better rain system in week 2. That would be the week after Thanksgiving holiday, which some forecasters are now starting to talk about.
It's interesting you say that, because soybeans have actually been the price leader for the last few weeks here, pulling corn and wheat along with it. So now the roles are reversing or changing.
I think so. Excellent point, because what we saw was the Pacific Northwest price and the Gulf price, once the government opened back up again, hit 1260 plus in cash markets. That's a great measuring stick, I should say, for whether this market maybe is over or not when it comes to the Chinese and Asian demand. We're about 30 cents off that Pacific Northwest high, about 1230 on Tuesday's close. I wouldn't want to see us go back below $12. That would maybe cause some alarm bells to ring that we've run this market up. So yeah, that's exactly what's happened, is we saw that cash market move us higher while the government shutdown was going on.
So the China business is essentially all priced in here. So now, is South American weather or a problem in the Southern Hemisphere the only thing that really could rally this market?
It's the main thing. I would say the bean oil market could do a lot of good if we'd see either policy adjustment by Washington, but you notice that the ethanol biofuel policy has kind of turned against the ag sector, and big oil's winning that here in the last 3 weeks. So I'll be watching soybean oil, crude oil, but yes, weather in South America. Everyone has asked me what would bring China in to buy that 6 million tons a month. It would be weather, because I think they're oversupplied right now. But with Argentina and Brazil running thin, if we had a real weather market, that would really change the dynamic, and I think put them more on the defensive.
Last week's lows in the grains, how important are those to hold for corn, soybeans, and wheat at this point?
I would say soybeans, they could pull the whole market lower if the South American rains come, just because it is all attached, or almost all attached, to the Chinese demand. And so I would be fearful that if the beans gave up the ghost, then the corn and wheat would follow in sympathy for a time.
Cattle higher, except for the nearby live cattle futures, but at least bouncing off of some new lows for the move here. Do we have all of the negative psychology from the plant closure from Tyson worked in?
I do think we have factored in the perception, the fear of oversupplying this market. And it was the Brazilian beef tariff being cut and the Packer news that I think came together in kind of a perfect storm late last week and brought us to where we were on Monday, Michelle. But the cattle on feed report, I don't think got traded until Tuesday. And this is where the deferred markets started to pull back up, the front end markets. And that suggested to me that the trade's saying, hey, wait a minute, we may have ample supply right now, but we're tightening very rapidly because of these weight breakdowns on the placements, 10, 11, 12% lighter than October of 2024, excluding the 7 to 799 weight group. So I think we're at peak placements at this point. And by the time we get to January, I would hope that we'd see on feed back below 11.5 million head. If that's the case, and we haven't lost a lot of demand, with this winter weather coming in and calving season right around the corner, why wouldn't we want to put some premium back into this market?
So, Mike, when does that psychology start shifting back around? Because this market break hasn't been about fundamentals. It's been about psychology. How do we get the funds back in?
Yeah, I would say it's been a mix, because what we did in 14 and 15, and that's still, I've taken a lot of heat, Michelle, but I still feel like 14 and 15 is a good measuring stick. We dropped feeders 14% from the October high to the D-slow. We've taken feeders down 20% now with this break. And that was mainly because we rebalanced. We weren't fearful of only supply and red hot demand back in 14, 15. That shifted. And I think we went through that shift here recently. So I have told clients and subscribers, we get a good weekly close this week, I'd probably come back and look at some known cost buyback in Dece, Feb, and April fat cattle, just in case I had to make some really bad sales.
And the hog market, are we just seeing some short covering there because it looked like maybe a little spread unwinding with cattle as well, or not?
Yeah, I think so. I think the cattle and the hogs, once they get done, working around each other in their own the fundamentals of their spillover fundamentals, I think the hogs will look at the ham market. And once we get the ham cut out, to bottom, and we haven't done that yet. I think that may present an opportunity where that 900 million pound cut that USDA gave us on the WASDE report can finally get factored in. I think the 900 million pound cut and China's economy are what's going to drive the hog market. I'm not a bull in hogs right now, but I would say it should be undervalued at this point and not need to go any lower unless the cattle open up to the downside again.
Thanks so much, Mike Zuzolo with Global Commodity Analytics and Markets Now.
When you choose Brevant Seeds, you don't just win. You win so big, the very ground beneath your feet cries tears of joy. You win so big that second place feels like a participation trophy. You win so big, you might as well be harvesting buried treasure. Oh, sorry, just one more. When you choose Brevant Seeds, you don't just win. You hit the damn jackpot. Don't just win. Win. Talk with your retailer or visit Brevant.com/jackpot to get started.